When to use subprime mortgages. In this video, I'll discuss Canada's subprime mortgages and when to use them. Thanks for tuning in to the first episode of Mortgage Sense. My name is Adam Sale. I'm a BC licensed mortgage broker located in beautiful Vancouver, BC, Canada. So really quick here, I just want to let you know that this channel is all about educating you on what I've learned in the Canadian mortgage industry. I'll do my best to keep these informative without sounding too salesy. In today's episode, I'm talking about a key difference between subprime mortgages and prime lenders and how to capitalize on this difference. Then, in part 2, I'll discuss the differences between prime lending prices and subprime lending prices. So let's get started with a bit of history. After the 2008 financial crisis, subprime mortgages have got a pretty bad reputation, which is probably why they are called B mortgages or alternative lending in Canada. And funny enough, since the stress test rules came into play, the market share of subprime mortgages is growing rapidly. But why is that? Well, after 2008, banks realized that they were exposed to too much risk in the mortgage industry, so to mitigate this risk, they began tightening their loan requirements. And then recently, there's been a lot of news about organized crime laundering money through real estate transactions. So once again, banks went back to the drawing board and tightened their regulations around anti-money laundering laws. This has caused many small business owners to use subprime lenders for the relaxed income confirmation rules. Now you may be thinking, should these people even be purchasing a property if they have to go through a subprime lender? Because isn't that risky? Not entirely so, and let me explain why. When someone wants a mortgage through a prime lending channel, such as a TD or a Scotiabank, these banks are required by law to use the 2-year averaging rule. This means that we're going to calculate the average income based on our client's most recent 2 years of tax return documents and determine how much the bank is allowed to lend our client. Now, based on this 2-year averaging rule, there are a few scenarios that could hinder our individual. For example, let's say our client's name is Steve. Steve is a plumber. Steve's been plumbing for multiple years and as an employee, and in the last year has decided to start his own company. He's through his first 6 months of business, he's been getting clients, and things are going great. Yay, Steve! So now he's looking at purchasing a house. When Steve goes to a prime lender, they're going to ask him if he's employed or self-employed. As soon as he says that he's self-employed, the bank is going to ask him for his last 2 years of business tax returns. Now, since Steve's only been operating his business for 6 months, he's in a predicament. The bank is going to tell Steve he won't be allowed financing until he produces 2 full years of income tax returns. Not only will Steve have to wait, but now he has to make sure that he pays himself an adequate wage from his company for 2 years so that he'll be able to qualify for the loan amount that he wants. If Steve ends up expensing too much, his income is going to come in too low and he won't be able to service the mortgage that he wants. This is where an alternative lender comes in and fills this gap in the market. If Steve's been operating his business for as little as 6 months, an alternative lender will be able to extrapolate that income over an entire year and get Steve the financing that he wants. This mortgage product is called a stated income mortgage, and it works by using Steve's bank deposits and invoices rather than his tax returns. So now, instead of waiting 2 full years for Steve's income taxes to come out, we're able to generate a financial picture of how much Steve's revenues will be for the entire year by looking at his last 6 months of business. With this estimate of revenues, we then use a worksheet and deduct the necessary business expenses to arrive at our new stated net income. We will then qualify Steve based on this new figure. These stated income products are not new and are in fact offered by most prime lenders if the loan-to-value ratios are below 65%. Now you may be asking, what's the catch? There's got to be a catch, right? There's got to be a catch. And of course there is. It's in the pricing. The more flexible or risky a mortgage is, the higher the cost of financing will be. In part 2, I'm going to break down the cost difference between prime lenders and subprime lenders, and we'll also take an in-depth look into Steve's scenario one more time. If you would like more information, please send me a message or give me a call. I'm happy to help, and don't forget to comment, like, or share this video if you found this informative. Thanks for watching, and I'll see you in part 2. Cheers.